Welcome to Talk Tickers, where we break down the earnings calls that move the markets. Today, we are diving deep into Domino's Pizza, ticker DPZ. Now, the stock had a great day after they reported Q4 earnings, but honestly, the headline numbers were kind of confusing. So let's figure out what's really going on.
All right, here's how we're going to slice this up. We'll start with the quarter at a glance. Then we'll unpack management's profit power strategy. After that, we'll cover their guidance and what investors were asking about. And we'll wrap it all up with our own take and a plausible trade idea.
Okay, first up, the quarter at a glance. And believe me, this was a real head-scratcher at first.
So here it is, the central paradox of the day. They missed earnings per share, but the stock rallied hard. So what on earth did the market see that the headline EPS number didn't show? This is where the story gets really interesting.
The market just completely shrugged off that tiny 2-cent EPS miss. Why? Well, because it saw what we call a much higher quality beat in the numbers that really matter for the future. I'm talking about that better-than-expected revenue and, most importantly, the beat on U.S. same-store sales. That signals their core engine, the U.S. market, is really picking up steam. And here is the market's final verdict, all in one number. The stock closed the day up over 4%. And get this, it was on more than 3 times the average daily volume. This wasn't just a casual drift higher. This was a powerful move, backed by some serious conviction from investors.
And the good news didn't stop there. Wall Street loves to see this kind of stuff, really disciplined capital management, a huge 15% dividend hike, consistent share buybacks, and they're even getting their debt under control. All of this just screams to investors that management is confident and in control.
So how exactly did they manage to pull this off? Well, it all comes down to their core strategy, something they're calling the profit power playbook.
The CEO, Russell Weiner, he really summed up the whole strategy with this one line on the earnings call. The idea is brilliant. Instead of just jacking up prices, they're driving so much volume with great deals that they can keep customers happy and grow profits for their franchisees. It's a really powerful idea in this kind of economy.
This whole profit power concept is driven by what they call the hungry for more playbook. Think of it like a 4-part attack. First, they lure you in with unbeatable value. Then, they keep you coming back with new, interesting food. They make ordering a breeze with their digital platform. And finally, they're expanding their reach by teaming up with partners like DoorDash.
Okay, so that's the strategy. But what does the road ahead actually look like? Let's get into their official guidance.
So, management's long-term outlook for 2026, it paints a picture of just steady, solid growth. They're targeting around 3% for U.S. sales and a really big push internationally with almost 800 new stores. But the number to really watch here is that projected 8% operating income growth. That right there is the profit power concept in action on their forecast.
The Q&A session with analysts really laid out the two sides of the coin here. The bulls are betting that this strong U.S. performance is just the beginning. But the cautious folks are keeping a close eye on their international business, which needs a bit of a turnaround, and of course, those persistent cost pressures from things like insurance and labor.
All right, so we've heard the company's story. Now, here's what we think about it. Here's the Talk Tickers take.
We are initiating our rating on the stock as outperform. Bottom line, we agree with the market on this one. The real story isn't that tiny EPS miss, it's the fantastic quality of the growth they're seeing in the U.S., and frankly, we think this positive story has a lot more room to run.
And this chart, this is the key to our whole thesis. Just look at this. Over the past year, Domino's has been left in the dust by the S&P 500 and even its own consumer discretionary sector. This massive performance gap creates a really compelling catch-up opportunity. If they can just keep executing in the U.S., this stock has a ton of ground to make up.
So finally, for those of you who might be looking for a way to position for that potential catch-up, here is what we're calling an outrageous but plausible trade idea.
The play here is to use options to get some leveraged exposure to this potential re-rating we've been talking about. By using long-dated, out-of-the-money call options, maybe with an expiration 6 to 9 months from now, you give the thesis time to play out over the next couple of earnings reports. It can be a capital-efficient way to bet on that continued momentum, and the best part is, your risk is defined to whatever premium you pay for the options.
So the whole thing really boils down to this one key question for investors. Is the strength we're seeing in the U.S. durable enough to power this stock higher and finally reverse that full year of underperformance? The playbook is set. Now it is all about execution.
And that is our take on the call. As always, please remember this is not financial advice and you should always do your own research. Thanks for watching Talk Tickers.